which is 10. So guys, the book value of the PP&E that you sold was 30. And you had a gain on sale of 10. Now, all the cash that you got in from the sale of this PP&E is a cash inflow from investing. Now, this naturally includes the gain on the sale. If you had a loss on sale, so let's say if you sold it for 25 bucks, sold it for 25 bucks, that means you have a loss of 5. What's your cash inflow? Book value was 30 minus 5 of loss. Net, what came in cash inflow? 25. So this 25 is the number which would go in the cash inflow from investing. So all the gain or loss on the sale of PP&E, that's not operating, that's part of investing. Now, let's look at investments. So let's say you've bought investment, marketable securities. So you've made investments to cash. Let's say you made investment for 100. Is this a cash inflow or a cash outflow? Cash has gone out, cash outflow. It's a use of cash. Now, let's say you sold this investment for $125,000. So now cash came in. How much cash came in? 125. Investments, there was 100, and there's a gain on sale of investment, 25. Now, when you purchased, when you made an investment, all this 100 cash outflow was part of your investing activities. When you sold off this investment, all the 125, so this includes the 100, which was the purchase price of the investment, and 25 gain. So all this 125 is part of investing activities. So guys, this is a concept that you need to be very comfortable in, and we'll talk about it again and again when we do some problems on cash flows. We've talked about operating activities, where generally our focus was on the income statement and on the current side of a balance sheet. We've talked about investing activities, where our focus generally was on this non-current side of the balance sheet. We looked at investments, we looked at PP&E, intangibles. Now, let's talk about financing activities, the finances of our business, the guys who have paid us to start our business, to run our business. So how do you get money? You either borrow money or you have your owners inject capital. So that would be loans taken or loans borrowed. You could issue bonds. Now here, you made out loans, you invested in others. Now you're borrowing loans. Here, you invested in somebody's bonds. Now you're issuing your own bonds, bonds payable. Well, we could also have equity. So our owners injecting in capital. So guys, let's compare investing versus financing. When I'm making loans, giving loans to others, when I give the loan, it's a cash outflow. When the other party clears off the loan, that is a cash inflow from investing. But now, to run my business, when I borrow a loan from somebody, that's a cash inflow from financing. When I clear it off, that's a cash outflow from financing. Investments. When I make investments in somebody else, that's a cash outflow from investing. When I sell off the investment, that's a cash inflow from investing. When I issue my own bonds, in that case, it's a cash inflow from financing. When I retire my bonds, when I pay them off at maturity, that's a cash outflow from financing. When I bought my PP&E intangibles, that was a cash outflow from investing. When I sold them off, cash inflow. Similarly, equity. When the owners inject in capital, when we issue new stock, that's a cash inflow from financing. Let's say when we go out to the market, buy back our own stock, treasury stock, that's a cash outflow from financing. So guys, you got to be comfortable about cash coming in, going out. Cash coming in, it's a cash inflow, sources of cash. Cash going out, it's a cash outflow, uses of cash. Now, one thing that you need to note here. So I said interest received, dividend received on these investments, that's operating. When I said interest paid on these bonds, that's operating. Now, when you have dividends paid out to your equity stockholders, dividends paid out, can you expense it on your income statement? No, it's not an expense. It's a distribution to owners. That reduces the retained earnings out here. So dividends paid out, that becomes financing activities. That's not operating. So dividend received is operating. Dividends paid out, that's financing. So guys, we've looked at operating activities, investing activities, financing activities. Now, during the year, we could have net cash used by operating activities or net cash provided by operating activities. You could have net cash used or provided by investing and financing activities. Then you sum total all these three changes. You look at the total change in cash. Then you look at what was the cash at the beginning of the year. That gives you your cash at the end of the year. So let me quickly look at an example that you have on your book. So this one has net cash flows from operating activities, and this number is 470. So we had a positive cash flow here, cash coming in from operations, $470. It seems we made a lot of investments this year. Cash went out due to investing activities, $750. So cash, there was a net cash inflow from operating activities, basically net cash provided by operating activities, 470. Net cash outflow from all these investing activities, 750. That means cash used by investing activities. Then we also raised some money this year, so there was a net cash provided by financing activities. That means the net cash inflow from financing, and that was 390. Now guys, if I sum total all these three, it comes to net cash inflow of 110. So I could say the net increase or decrease in cash. So net increase or decrease in cash, that's 110. Now to this, if I look at the cash at the beginning of the year plus beginning cash balance, and let's say at the beginning of the year we had a $50,000 of cash. What's the net cash at the end of the year, or the ending cash balance? So guys, look at it. The statement of cash flows has provided us all the information about how cash has increased or decreased during the year, whether due to operating or investing or financing activities. So that was $110,000 for this year. Then we added the beginning cash balance, $50,000, and we got to the ending cash balance number, $160,000. Now guys, look at how the statement ties into your balance sheet. Here you have this number, $50,000. That was the cash at the beginning of the year or end of last year. So that's your number 50. The last number, ending cash balance, $160,000. That's the cash and cash equivalents at the end of current year, $160,000. Change, 110. And that's what we've been talking about here. So guys, we're looking at operating, investing, and financing activities. The statement of cash flows is a required financial statement whenever a company is presenting the results of its operations for a year. Put a box around required financial statement. On the third bullet there, you got three categories of activities in the statement of cash flows. First one, highlight operating activities. And this includes collections on sales from customers, cash payments for purchases, and for SG&A. The tricky ones here, highlight interest received, highlight dividend received, and highlight interest paid. So even these are operating activities. Now, operating activities also include acquisition and disposal of trading securities, payments for income taxes. Next one, highlight investing activities. Now this is principal collections or loans made by the entity. So when you make a loan, that's a cash outflow from investing. When you collect, it's a cash inflow from investing. Acquisition or disposal of available for sale or held to maturity investments. Again, when you make an investment, it's a cash